Today on the Final Bar, we will recap today's market. Choppy sideways action today with financials continuing to lead and energy at the bottom of the sector list. So we'll break down some of those themes. We'll open up the Final Bar mailbag, talk about the material sector, talk about sector rotation, equal weighting some of the consumer sectors, what that means, and talking about a good routine to go through stocks. We'll also level up our look at the historical chart gallery. Ladies and gentlemen, this is the Final Bar. Welcome to the Final Bar, everyone. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in Redmond, Washington. Really appreciate you joining us today and every day. The goal of the Final Bar is to wrap up today's price action, to sort of deconstruct some of the movements that we've seen, try to understand the themes and the short-term fluctuations, but most importantly, connect it to the long-term trends. It's so easy to get caught up in the flickering ticks, the short-term movements of the market. And I think the best thing that you can do as a long-term investor is understand how the short-term relates to the long-term and make sure you have a good long-term orientation. A little later, we're going to talk in a couple segments about having a good long-term view, looking at the historical chart gallery as sort of a long-term routine, but also answering a question about a good stock routine. So we're going to hit all of that today. Before we get to that, we are actually departing the office here very shortly after we wrap up the show today to head down to Las Vegas for the Traders Expo. So I hope to see many of you there. I'll be speaking on Friday evening, just before dinner, talking about the 5 modes of mindful investors, talking about some of the behavioral biases that can get in the way of good decisions with your portfolio. So certainly hope to see you there, and please make a point of saying hello if you do attend. There's a link on your screen that'll show you how to get to the sign-up form for that. There are also some streaming options if you're not able to get to Las Vegas. So check that out for sure if you haven't already. Good news about this market choppiness, market volatility as we recap today's market action is, over the next couple of days down at the Traders Expo, we'll be asking a lot of these speakers there, sitting down with them one-on-one and understanding their take on the market, sort of getting their short-term view on what they're seeing and also their long-term view, how they see the markets going into year end and into 2020, and just starting to understand from each of their perspectives what they're seeing. So let's start to answer some of those questions ourselves today, and we can see how that compares to what we hear over the next couple of days down at the show. So today's price action, pretty choppy. The Dow, the S&P all ending essentially flat for the day. There's a lot of choppiness in the market, sold off just before lunch, but recovered. And in the end, directionally, we really didn't go anywhere today. It was sort of a flat movement. Looking at the sectors, though, you can see there is plenty of differentiation with financials, consumer staples, real estate, utilities at the top. So with the exception of financials, which has really been an emerging theme, we're back to a little more of a defense with staples, real estate, utilities sort of at the top of the relative list. At the bottom, we have materials, technology flat for the day, but underperforming the market by just a touch. Comm services, and then energy at the very bottom. Energy has certainly been one of the more volatile charts, volatile sectors. We've talked about the XLE and sort of looked at it a number of times, but tested the 200-day from below, and in 3 days has sort of had this quick reversal pattern, a gap up on the XLE on Monday, going even higher, following through on Friday's nice rally, breaking above the 200-day yesterday, but closing back below. And now we sort of confirm a successful or an unsuccessful test, I guess, of the 200-day with a little more distribution day in the XLE back to 60. So, I mean, this is one of those charts. We've talked about the potential emergence of energy. We've talked about the MEI trade, materials, energy, industrials, and the strength that we've seen. Today, certainly, they're more on the weaker side. And again, the charts of the XLE like that, that's why you pay attention to those long-term levels, right? Just 1 day's movement, 2 days movement is not enough. You really want to see how it does relative to key support and resistance levels, key lines in the sand, if you will. Let's look at a daily chart of the S&P, just to understand where we're at. So again, over the last 6 weeks, really, we've had this nice reversal out of the lows from the beginning of October, a nice rally higher to new trading highs, new closing highs a couple weeks ago. This was the last 2 weeks, into last Friday and then into this week. We really rallied up into Monday's trading, and Monday, Tuesday, Wednesday this week have been essentially sideways, choppy days, a little distribution, little accumulation, no real directional movement. We closed a little higher toward the end of the day after selling off. I guess that's one short-term positive, but overall the trend, undeniably is strong. We talked yesterday about the relative performance of semiconductors. All of that is still in place, suggesting it's really an offense-led breakout here, and there's a lot of potential movement to the upside. It's interesting. There's a story I read and tweeted out some thoughts on it earlier today about the amount of cash on the sidelines. There's a story in the Wall Street Journal today talking about the incredible amount of cash, and I would say that's a good thing. I mean, you always sort of anecdotally think of cash on the sidelines as a very good thing, because if the market's up this high and there's all this cash that has not yet been deployed into the equity markets, that could provide another whole leg higher as investors get more comfortable with it. On the other hand, we're fighting a demographic shift, which with the baby boomers retiring and naturally kind of taking money out of equities and putting it more in cash or cash-like items in now and maybe in the coming year. So the question is really, is a lot of that cash going to be redeployed, and is this just led by the Fed and sort of, I guess, quote unquote artificial modes of or means of demand? It remains to be seen, but we're certainly going to want to keep looking at some of those charts and how they emerge. We wanted to look at the candle glance page at some of the major U.S. equity benchmarks. So this is looking at sort of the major benchmark indexes we track to understand the U.S. Equities from a top-down perspective. I like to look down here to the S&P 100, which is really the mega cap names in the U.S., the mid cap and the small cap. And while the the largest names have really been driving things higher, the OAX was the first to break to new highs. Looks very similar to the chart of the S&P 500 here in the upper left corner. You can see how it rallied very, very well, has outperformed very, very nicely. But if you look at the mid-cap index, a lot further back, so still sort of testing that resistance level, not quite following through to the upside yet. And then small cap sort of at the end of the list, really, not quite eclipsing it. So while the OEX is sort of up here by the help button on your website, the small cap index has not quite broken on. So on the SML, this is the S&P small cap index, S&P 600 index. You can see this really clear resistance level from February. So this is the big rally out of the end of last year, that initial push where, it was, a strong relative performer. Small cap stocks were actually accelerating out of the lows, then kind of tapered off. And you can see how the relative picture sort of got weaker and weaker as the small cap index sort of stabilized, while a lot of the mega cap, large cap names have continued to appreciate. We went right back up to that resistance level. We're unable to eclipse it, unable to go to new highs. So something like the S&P 600, boy, a break above 1,000 would be what you'd want to see to really validate sort of a further upside there. We've not seen it yet. So a lot of people, again, have been sort of skeptical, and myself at times, certainly because of the lack of participation. We looked at the breadth chart yesterday, though, and there's no denying that if you look at the advanced decline lines on small, mid, and large cap, all in the positive, all sort of holding up very, very nicely. So overall, again, today's sort of a choppy sideways day, but the long-term trend still very much in play to the upside. The next segment here is opening up the Final Bar Mailbag. As you know, there's 3 ways to get a hold of us and send your feedback, send your questions in particular. We really appreciate those. You can email us, thefinalbar@stockcharts.com. You can get to us on Twitter @FinalBarSCTV, or just put a question in the chat room during the show today, and we'll make sure we review each of those and all the best questions that are appropriate to address in there. We'll certainly make a point of doing so. So a couple questions that have come out of the mailbag recently that I thought were actually really interesting. One was involving sector movements, and particularly looking at materials. So the question was, if materials are leading, if you have that strength from the materials sector, materials sort of breaking out and a gap up on Monday. So the weekly chart suggests a test of the high from the beginning of 2018. So our materials, sort of those basic material names, part of the new leadership. Really interesting question. And I would say materials is such a small sector. So if you think about it weighting wise, if you think something like consumer discretionary, communication services, technology, financials, these are all pretty big sectors, 15 to 20% of the S&P, large sectors that really drive the performance of the index. Materials is almost a rounding error. So the material sector is only a couple percent at most. And so it's such a small weighting that I found a lot of institutions sort of mentally push it aside because, obviously it's very aligned with commodity prices. So a lot of times it's a commodity play, although there are things like chemicals and other groups within there that can be a little different. But a lot of times it's essentially a read on the commodity complex and whether those are going to do pretty well. But because it's such a small weighting, you don't have to worry too much about it because if you're not there, it really doesn't hurt you if it starts to do pretty well because it's not a huge thing. On a relative basis, the last 2 years, this is what is a challenge with materials. Look at the last 2 years, relative strength line has just gone down and to the right. A lot of that underperformance came in 2018 when broader equities were doing much better. And even going into the low at the end of December, materials kind of rallied, but then immediately in the new year, as sort of the offense led, materials continue to taper, and it's been flat to down since then. So not to the relative lows from the end of last year, but not far above them either. So overall, the challenge is it's not been a big relative performer. It has gone higher, and on a weekly basis, you sort of see the jump up with the Monday close higher. So the question is, what does that mean? So I would say, number one, I'm always interested in stocks, in groups, in sectors that are breaking to new highs. I especially look at 13-week highs. You probably figured that out by now. So that's certainly of interest to me. But I'm also going to be paying attention to what the leadership is. And so I've talked a lot about the MEI leadership, materials, energy, industrials. Right now I'm showing the sector rotation model. I'm going to zoom in just a bit so it's a little easier to see on the screen. This is something that our friend Sam Stovall, who's at S&P for years and years, wrote some really good work on sector rotation. This is sort of the graphic that we've had on our website for a number of years, illustrating the traditional rotation of sector leadership, right? So late in a bull market phase, when you get to, this is the stock market in orange, this is the economy in blue. The stock market tends to be a leading indicator for the economy. At the end of bull market phases, you start to get leadership from the MEI trade, the late cyclicals, materials, energy, and industrial. So what would concern me is if you have materials doing really well, industrials doing well, if you would get energy participating as well, that's traditionally sort of at the end of a bull market phase. That's not the beginning of a new dramatic upside. Now, again, this is all based on medians and averages and multiple cycles. A lot of things can happen outside of this idealized rotation, but you will hear a lot of people talking if you get materials, energy, industrials leading, sort of speculating we're at the end of that, speculating on a potential recessionary period going forward, and a sell-off in stocks would be the first leading indicator of something like that happening. So that's my quick take. Thanks for the question on materials leadership. That's how I would sort of think about it. And again, I'm always interested when stocks groups are going to new highs. The second question, I love to show a chart of the consumer discretionary versus consumer staples, which is down here at the bottom half. This is a similar chart that I've shown a lot. I talk about the offense versus defense within consumer. Someone mentioned the equal weighted consumer discretionary versus staples, which is a really nice suggestion. So I brought up these two ETFs. The RCD is the S&P equal weight consumer discretionary ETF. And the RHS is the equal weighted consumer staples ETF. So if you're not familiar with weightings, so basically the S&P sector spiders and the sector indexes are cap weighted, market cap weighted, meaning it's weighted, skewed toward the largest companies. The largest stocks in the sector are going to be the biggest weight. And so if those big names have trouble or if they do very well, the index overall is going to follow that because there's such a big weight. And some of the smaller names are going to have less of an impact. These equal weighted ETFs are kind of an artificial construction, equal weighting all the names. So the smallest member of consumer staples has the same weight as the largest consumer staples names like P&G and other names that you probably know. So it's an interesting measure on breadth, especially to compare the two. So here we have the cap weighted XOY and XLP that I usually show. At the top, we have the equal weighted. So what's happened is the equal weighted has actually already broken above trendline resistance and broken above the resistance from September, suggesting that if you equal weight them, that you are seeing a rotation back to consumer discretionary. And maybe it's just the largest discretionary names that are not doing as well, or the largest consumer staples names doing a little better than average, and that's what's causing these two to diverge. But a lot of people like to follow the equal weighted indexes. We sat down with Craig Johnson a couple weeks ago in Minneapolis. He's a big fan of looking at equal versus cap weighted by sector. And so I think he would certainly appreciate this sort of look. So great suggestion, great question. And that's certainly what I would point out to you. So that is our mailbag session for today. Again, please keep sending your questions. We're getting a good flow of questions from all of you. Really appreciate it. We'll make sure that we hit some of those key points in a later mailbag session. We're going to take a brief commercial break, then we'll be back with my guest, Willie Delwiche. He's the chief strategist over at Robert W. Baird. Really thoughtful analyst. I think you'll appreciate his comments. So back with Willie in about a minute.
Today's market volatility provides savvy traders and active investors with an abundance of profitable opportunities. At the Traders Expo Las Vegas, November 7th through 9th, over 75 of the most respected traders in the world, including Dennis Gartman, Tom Sosnoff, Todd Gordon, and Tom DeMark, will explain how they're adapting their strategies and share the specific trading opportunities they've identified in equities, options, forex, futures, cryptocurrencies, and more. Claim your free pass to join them at tradersexpo.com.
Hello, everyone. Welcome back to the show, The Final Bar. I'm your host, Dave Keller, here at StockCharts.com. I want to welcome on my guest, Willie Delwiche. Willie's at Robert W. Baird, the chief strategist there. Willie, thanks so much for joining us. Really appreciate it.
Yeah, thanks, Dave.
You were thoughtfully sent us two charts ahead of time. Really appreciate it. The first one is looking at copper, what a lot of people would call Dr. Copper, and then the emerging markets index. What are you seeing here? How should we think about this chart?
Sure. So I'm glad you made the reference to Dr. Copper. That's how a lot of people think about copper in terms of an indicator for the economy. I think if we want to think about it with respect to emerging markets, we can actually put the PhD aside and pull out the CMT. Copper is a great indicator for emerging market stock market strength. There's a great signal there. They move together. As not just a kind of esoteric aggregate demand. There's actually a relationship there. So the thing I'm taking away from it, one, copper had a chance to break down earlier this summer, and it didn't. And that was in a seasonally weak period for copper. And so if something's not weak when seasonals say it should, then that kind of draws an alert in my mind and says, okay, well, is something changing here? And since summer, we've seen copper drift higher. Hasn't broken out yet, but it's working really hard at it. And if it does, and it's setting up to challenge its 200-day moving average, challenging the downtrend that emerged off of the mid-2018 highs, that would suggest that you're seeing this transition in leadership towards emerging market strength. And that's what the bottom clip shows, is that emerging markets are starting to act a lot better than what they have over the past 2 years. And so, you talked before about some of this rotation from a sector perspective. I think we can look at it too, U.S. versus international, and you're starting to see a rally that isn't just driven by what the mega cap U.S. stocks are doing, but broader in terms of U.S. strength and broader in terms of global participation.
This is such a great chart. Willie, we've showed a chart a number of times in the last couple of weeks, just looking at the relative performance of U.S. versus the rest of the world and seeing that rotation. And obviously U.S. on a relative basis has done much better than international markets for the last couple of years. But in the last month or two, you've all of a sudden started to see this rotation where some of these, emerging markets and even developed markets are doing well. I mean, if you're an individual investor based here, how would you start to think about those global markets versus in the U.S.? How should they fit into sort of the overall approach, do you think?
Sure. So what I've been telling Baird financial advisors to tell their clients is now is the time to start thinking about diversification again. It's been quite a while since there's been a strong case for it. If you've diversified overseas in the last few years, you've gotten worse returns and more volatility.
That's right.
But you're seeing that change now. Data point for you. About 69-70% of S&P 500 stocks are trading above their 50-day moving average. 75% of Europe ex-UK stocks are trading above their 50-day moving averages. So you're seeing not just index level strength, but you're seeing breadth strength that is shifting overseas. And so what it says is follow that trend. Start to think about emerging markets. Start to think about Europe ex-UK. Start to go into areas that have been a little bit under-owned because they've lagged for a while, and maybe as we look forward over the next year, the next 10 years, then we'll be able to say, yeah, diversification does work. It does pay to follow strength into areas and not just be stuck in a kind of a U.S. large cap portfolio.
That's great points, Willie. Now, speaking of breadth, the second chart you sent us was looking at the value line geometric index, but then also looking at a breadth measure on the S&P. What are you seeing here? Yeah,
so if call me crazy, but I really like the value line geometric index. It's an end-of-day index, so you can't watch it over the course of the day. But what it does is it tells you what the median stock in the value line universe, so it's like 1,700 stocks or something like that, what that median stock is doing. And the story there has been, while the S&P has been making new highs, the median stock has lagged. And so you saw it particularly since the latter part of 2018. And as the S&P was making new highs earlier this year, the value line geometric index was making lower highs. And so, and was actually making lower lows as well. Now, since September, that's changed. You've had, you had a higher low in the value line geometric index in October. And now as we've moved into November, we're starting to take out some of those previous highs. And so again, just like the global picture is improving, the domestic breadth and picture is improving. And that's, you see that too in terms of the bottom clip there. More S&P 500 stocks are trading above their 200-day moving averages than we saw even just a month ago. And so if that breaks out above 78, 80%, again, that'd be another sign that this rally that we're seeing now, that the S&P 500 is getting a lot of attention for it, but it's much broader than that domestically, much broader than that internationally. And the way I would think about that, particularly from a domestic perspective, is not chasing the S&P here, but thinking, okay, if you've got broad support, then maybe some of these laggards, you talked before about materials and industrials, I'd throw financials in there as well. Some of those lagging sectors can start to play catch up. And so you get this rotation from tech, discretionary, utilities, real estate leadership, and into areas that have been kind of tossed to the side over the past year and a half. So financials, industrials, materials even. So it's setting up for a broad strength, even if it doesn't translate into this persistent trend higher in the S&P 500, it's a much stronger rally than we've seen over the past year, 2 years.
Willie, those are two solid charts, and I really appreciate the take, especially thinking about non-U.S. versus U.S. markets. Listen, thanks so much for coming on the show. Really appreciate it.
Yeah, thanks a lot, Dave.
All right, folks, that was Willie Delwiche. Really appreciate his take from Robert W. Baird. Two fantastic charts talking about big picture and certainly strength in the U.S. and abroad. We're going to go to the next segment very quickly. This is Level Up. We're very quickly going to talk about a feature on the site. I was talking with our producers before we started. What is an area of the site that we feel that people are not using enough? And we threw out a number of ideas and actually very quickly found this one. And if you go to the main charts and tools page, this is the upper left corner of StockCharts, click on that. This shows you all the different reports, all the different analytics. And if you've not looked at this in a while, do yourself a favor, kind of go through those, because especially on the right side, there are a lot of things on there that you're probably not using that could make this a little more helpful for you. But one that I wanted to make sure that you saw was toward the bottom, there's what's called the historical chart gallery. And I met recently with Gaddis Rose, who's a longtime contributor to StockCharts. We were talking over lunch about different things, and he was talking about the historical charts on the platform, and I started looking at them. There's actually some really cool, very long-term charts about market history. And my conversation a couple weeks ago with Ralph Atkimpora, we talked about the deep history of the U.S. equity markets, talked about the Great Depression, talked about the rallies that occur even within, cyclical weaker periods over time. And looking at some of these historical charts is where you really start to put details, put numbers behind some of those general assumptions. So what did the 1970s bear market, secular bear market, really look like? And what were the 50s and 60s leading up to that point? What kind of comparisons can we make now versus some of these other periods? And again, there's a lot of themes, a lot of stories that, that are behind these lines, but it gives you a starting point. So when you look at that historical chart gallery, there's 4 categories on here. The first one is important market indexes. That gives you a really long-term history, monthly data going back, to the beginning of last century in a lot of cases, showing you the deep history of some of these. You can click on those and start to customize them, save them to your login. There's some really cool ones. Also gets into things like housing, prime lending, treasuries, inflation. So make a point of going through there. I'm going to show market fundamentals here. We have a couple charts looking at the long-term earnings, long-term valuations. This is an area of the product that we're actually doing a lot of work right now. We'll hopefully be adding very soon some additional fundamental data to help you understand equities and sectors a little more helpful. But as you go down, there's a section on market breadth indicators. And then finally, this one that's really timely, looking at presidential cycles. And the way that we illustrate this is going through each of the 4-year periods, each term of each president, and showing you the equity markets in the form of the Dow, but also commodities, interest rates, and the dollar. And again, going through an election cycle, going through coming to an election year, go back to some of these charts and actually see what the market has done in similar political periods. And again, it's not the answer, it's not the holy grail that you might be looking for, but certainly gives you an interesting look at what history can tell you. Again, history often doesn't repeat, but it usually rhymes. So that's the historical chart gallery. You can get it on the chart and tools page. We find people tend to underuse that, and I'd encourage you to check it out. We're going to finish today with the Final Bar 3 and 3. As you know, at the end of every show, we like to go through 3 charts in 3 minutes. If these are not on your radar, I'd certainly encourage you to create these, save them to a chart list, keep track of these in the coming weeks and months. I think it's going to help you get a good read on the market environment. The first one we talked about earlier, and we're in the mailbag session, we were talking about equal weight versus cap weighted ETFs. Here we're looking at consumer discretionary versus staples on a cap weighted basis at the bottom, an equal weighted basis on the top. This came from one of your questions, so thank you so much the person who asked about equal weighted and pointing out this reversal. So this could be an interesting leading indicator on a rotation away from the defensive and into the offensive part of consumer discretion, or for a part of consumer in the form of consumer discretionary. So I'll certainly be watching this chart now to see if we get the follow through from the cap weighted indexes. So great question. Second one is to show you the Dow Furnishings Index. This is one of the industry indexes, and I'm showing this because we recently added Scooter Rankings, our technical rating system for all of the industry indexes. So if you go to the industry summary page, which you can get to from the toolbar, you will see a list of all the sectors, all the industry groups by Scooter ranking. You can actually sort them there. So out of all the U.S. industry groups, the number one is furnishings, which is in the consumer discretionary sector. It is the number one ranked industry group. It's extremely overbought right now. Strong relative performer. This is stocks like LEG, Leggett & Platt, MHK, Mohawk are in this group, both with some really attractive charts continuing to go to new highs and highly rated on their own Scooter ranking. So again, it's a great way to find groups like this that have really emerged as leadership. Might be worth paying attention to. The third one for the 3 and 3 is stocks versus bonds. I usually do it this way, looking at the spiders versus the TLT. So this is the main, U.S. equity ETF, and a pretty liquid bond ETF looking at bond prices. So if this is going up, stocks are outperforming. If it's going down, bonds are outperforming or stocks are underperforming. What's happened from the first week in October, which sort of completed this weaker period for stocks and stronger move for bonds, has now reversed, and we've seen a follow through back above the 200-day moving average average for the first time since over the summer back in July. So certainly favoring stocks and not seeing a rotation back to bonds on that. So that cycle has tended to be about a month or two, maybe 4 to 8 weeks at a time. And at this point, still favoring stocks over bonds at this point. So those are your 3 and 3 charts for today. And that is our show for Wednesday, November 6th. I want to thank you for joining us. You can email us any questions and feedback at thefinalbar@stockcharts.com. Get to us on Twitter at FinalBarSCTV. Also, check out our YouTube channel. We post all of our videos there. From Redmond, Washington, this is Dave Keller. Have a good night.